Joining us now to make sense, maybe, of today's big sell-off in both commodities and in stocks. We're pleased to welcome Nick Kolis, the Chief Market Strategist at Convergex. Nick, good to see you. Thanks for joining us.
Thank you.
You think there's a big dramatic turn in investor psychology for those investments right now, don't you?
I do. Let's start with gold, for example. Gold for many years, as you point out, has been a major inflation hedge. However, with the threats of many central banks in Europe having to sell a bit of their gold holding to fund their own restructurings, I think investors are very worried about a lot of supply coming to the market. Cyprus is just a teeny bit of it. You have areas like Portugal, Spain, France, even Italy that have tens of thousands of tons of gold in their vaults. And any part of that comes out, there's going to be a lot of supply.
Nick, a lot of investors tonight are scratching their heads and saying, what happened? All these past couple of weeks and months, there have been new records on Wall Street and all the stock averages, and they've been told that the economy is doing great. So what's changed?
You know, what's changed is that we got a little bit complacent. I think everybody looks at the market over the past couple of weeks and says, well, you know, we weren't really fully gauging what might happen if the economy slows down or doesn't speed up. And I think today was really just the reckoning for a lot of those concerns.
You know, we've been in a period where people have been expecting what they call a correction, maybe as much as a 10% pullback from whatever highs we've been hitting here lately. Do you think this is the beginning of that correction right now?
I think we're certainly seeing a bit of a correction. I don't know how much more it has to go, however, because fundamentally we still have very low interest rates, and U.S. corporations are still posting basically record high levels of earnings against the backdrop of a very weak global economy. I think the concern is that if we get a big downdraft from either whatever happens out of Boston or some other macro factor, that's the real risk factor. But as far as the fundamentals near term, very strong earnings, very low interest rates, hard to argue against stocks with that backdrop.
Nick, you just mentioned the Boston Marathon incident. We're still getting bits of information. We don't have the complete story on that tragedy, but events like that do impact investor psychology. How much of an impact?
Yeah, that's exactly right, Susie. You know, really two factors to focus on here. First, what effect does it have on consumer confidence? Because these kinds of events obviously scare people, and rightly so. So the first question is, how does it affect consumer spending? How does it affect consumer psychology? You know, the broader issue is a bit more nebulous right now, which is what are the geopolitical ramifications of the event? You know, we've had examples over the past 20 years of, you know, horrible tragedies like this, Oklahoma City or even 9/11. Some of them have very profound impacts on geopolitical balance and the economy, and some don't have quite a bit as much, and we just don't know which one of these it is yet.
Since the lows of last year, Nick, there's been a mindset among investors to buy the dips, as we say. As the market comes lower, they step in and see an opportunity to buy. Now, we've had a pretty good sell-off here the last couple of days. And so far, nobody's stepping in. Do you think they will, or should they at this point?
You know, I think in terms of thinking about how to invest and over what time frame you are investing, if you're investing for a 3 or 5 year horizon or longer, then ultimately you focus on the fact that corporate earnings are very strong despite a very weak global economy, and buying makes sense. If you're a trader, or if you have seen the action over the past couple of days and it scares you and you think you're overexposed to equities, then the opposite advice is true. It probably is time to take some off the table because you're overexposed and your risk comfort is obviously out of whack with reality.
Nick, you have a standard asset allocation, 60% stocks, 40% fixed income, and you really don't change it when the stocks are going up or the stocks are going down. So what is your advice to investors? What should they do right now? Just sit tight?
Yeah, 60-40 is a very solid split. It maximizes return and minimizes volatility. I think if you have seen the action over the past couple of days and you're comfortable with your portfolio, it makes sense to sit pat. My concern is that a lot of your viewers probably are sitting on some pretty sizable gains over the past couple of years. Maybe that 60-40 isn't quite where it should be. Maybe it's 80-20. For those investors, for those viewers, I would recommend paring back on equities because you're overexposed, even though the stock market's obviously done well.
Nick Kolis, the Chief Market Strategist at Convergex. Thanks for joining us.